Bayfront Infrastructure Management. Primod Thomas joins us next to talk about institutional appetite and infrastructure securities out here in the Asia Pacific. Squawk is back in 2. Fully. Now, G7 leaders recently announced plans for infrastructure investment fund to rival China's Belt and Road project. But most Asian infrastructure projects are financed by bank loans, which are, well, not suitable for institutional investment for a number of reasons. Bayfront Infrastructure Management, the platform for infrastructure debt investment, has securitized a portfolio of infrastructure loans, giving institutional investors a chance to take part in such projects. Bayfront recently sold $401 million in infrastructure asset-backed securities, or IABS, which saw strong demand. For more, Primod Thomas joins us, CEO of Bayfront Infrastructure Management, live from elsewhere in Singapore. Primod, good morning. Great to have you on the show, and always appreciate your time. So we were talking to a guest just minutes ago, and I ran the idea of structured finance related to infrastructure by him, including infrastructure asset-backed securities, and he was generally pretty positive with one caveat, and that is unless or until central banks around the world start raising rates too fast, too soon, and too aggressively. My question to you is, are we not at that point? I mean, this is the risk we've been talking about for the last couple of days since the last Fed meeting, that the first, we could have, 2 hikes maybe in 2023. We had the head of the St. Louis Fed, Jim Bullard, earlier, overnight in fact, talking about he thinks the first hike could come as soon as 2022. Does that make you concerned?
Good morning, Mark. It's great to be on the show. Thanks for having me on. Interest rates have been spoken about. There's been extensive commentary for the longest time. One of the points about our transaction is that we position ourselves as a floating rate product. In other words, we price our loans on the basis of a spread over 6-month LIBOR. So to the extent interest rates go up, the base goes up. And unlike a fixed income bond, we don't have the kind of contractions that a fixed income holder might have. So we're slightly different and somewhat inured to the impact of rising interest rates from the point of an investor. Our transaction really was structured as a means, as your earlier speaker said, to ease some of the pressure on banks who've traditionally been the big originator of project finance loans around this region. Given the fact that given Basel requirements on capital, there's an increasing pressure on them to recycle these long-dated loans. While they continue to be very good at originating such loans, the pressures, the regulatory pressures, make it difficult for them to hold these loans. Similarly, investors are pretty invested in getting into this particular space, and that's what we're trying to facilitate.
Yeah, I mean, I wouldn't be surprised if the banks, if you bought these liabilities and infrastructure loans from are pretty relieved. I think a lot of them would be pretty happy to be done with the kind of responsibility and pressure. So let's talk a little bit more about this. I mean, the buyers, institutions, this is institutional money we're talking about, long-term money, pension funds, etc., which will help them match their long-term liabilities. I get that. Is there a plan at some stage, or do you think it's likely for some of these big institutions to go ahead and connect the dots even further and start offering some of these products to retail investors as wealth management products?
Entirely possible, Martin. The objective of getting these exposures into the balance sheets of long-dated investors is precisely that. They have long-dated balance sheets and they wish to stock them with assets that have similarly long-dated tenures. And this is exactly what a typical project finance does, typically between 10 and 15 years in tenor. Banks are great at originating them and holding them till such time as they turn cash generative, in other words, move from greenfield to brownfield. That's where we as a platform show up and offer to buy these loans. We buy them, place them in a warehouse facility, and that's part of our balance sheet, while we structure them in the form of a securitized note, which we then sell to institutional investors such as insurance companies, pension funds, sovereign wealth funds, as well as specialist asset managers. In our recent transaction, we had strong interest from insurance companies in this particular area, as well as asset managers. Going forward, there is definitely potential for this to reach retail hands in the form of wealth management products. This is not something we are currently focused on, but in our journey ahead, and we are on a program, we plan to be doing this and coming back to market every 12 to 15 months. There is the potential for us to address a retail audience as well.
You know, long-term, maybe, of course, Asia is facing an infrastructure shortfall of billions of dollars. So, long-term, I understand this is potentially positive here. What I'm trying to figure out is, I take a look at the pitch sheet, your pitch sheet, and if I'm not mistaken, I think two-thirds, roundabout, two-thirds of the stuff that you're packaging is rated junk. Is that right?
Actually, it's significantly investment grade rated. What we do, there are two parts of the equation here. We buy sub-investment grade loans. Typically, the fact that they are not rated by Moody's is a point. But what we do then is we take these loans, structure them through a securitization technique, create capital tranches, class A, B, C, D, as well as an equity tranche, which we as sponsor hold. And in doing this, we create, through the ability to take that first loss piece in the form of equity, as well as the subordination intrinsic in such a capital structure, we are able to create high-grade investment notes, investment grade notes, which we then sell to insurance companies and pension funds, which by mandate are required to stay at the upper end of the credit spectrum. So what we do through this technology is we buy a diverse set of loans from a number of countries. For instance, in our last transaction, there were 13 countries that participated, 8 industry sectors. So through the diversification, through the capital tranching, through the first loss piece, we are able to generate investment grade paper in bite-sized amount with a certain amount of liquidity, because these are scheduled to be rated on the exchange. And as we bring more supply to market, we expect liquidity to be present in such notes. So a combination of all these make them quite interesting to institutional investors who want to get into the space, until now haven't found it easy to access on a bespoke basis individual project finance loans around the Asia Pacific. So this is what we do. We move around the region.
Okay, what you're basically doing is securitize the cash flow from ongoing infrastructure projects, and I take a look at the geographical breakdown and also type of infrastructure breakdown. Most of it is pretty basic infrastructure, including water, and much of it, India, projects in India take up a huge chunk, right? Yes?
So we do conventional power and water, we do renewables, we do integrated LNG, FPSOs, electricity transmission, transportation, roads. So pretty much the traditional definitions of infrastructure around the region. Yes, we do. The 5 big markets that we have in this transaction are India, Bangladesh, Qatar, Australia, and these markets have been account for more than 50%. Now, the India focus has been around renewables. You know, that's a market where there's been a very significant impetus over the last few years, where especially wind as well as solar projects have been banked very extensively. As banks do more of this, there's an opportunity for them to recycle their balance sheets, and this is the opportunity that we had to pick up a substantial amount of those renewable projects. In our transaction, it was very well received by investors. There was a sustainable piece. 30% of our notes were in the form of sustainable notes, and these are really notes backed by renewable projects, wind, solar, hydro, as well as sustainable social projects such as roads, as well as electricity transmission, as well as water desalination. So all of these projects form the basis of a sustainable note issuance. This was very well received, significantly oversubscribed, and we were able to charge what's referred to now as a green premium, a 5 basis point differentiation between how this note priced versus its conventional counterpart. So there was a strong interest for this particular segment, and there was a significant amount of supply from some of the South Asian countries, India being a notable one.
Wow, like that, the green premium. Listen, Pramod, come back, talk to us again very soon, and enjoy the conversation. Thank you for your time. Pramod Thomas from Bayfront Infrastructure Management joining us live. Thank you.